Someone remarked during the break that moving from my introductory section this morning to Dave's section in the afternoon was a bit like going from high school to brain surgery. Well, this is where we go from brain surgery to holistic philosophy. So we're going to shift gears again. In 1985, a very interesting article was published in several major newspapers, including the New York Times. It struck me so that I used it in a presentation to the Market Technicians Association in early 1986. The article was about the discoveries of a scientist named Benoit Mandelbrot, M-A-N-D-E-L-B-R-O-T. He had taught economics at Harvard, engineering at Yale, physiology at the Einstein College of Medicine, and the article was about his discovery of the fractal geometry of nature. I'd like to read some of the excerpts from the article that appeared in 1985. At the age of 61, Mandelbrot can watch his revolution advance. He has invented a new way of describing, calculating, and thinking about shapes that are irregular and fragmented, jagged and broken up. A new geometry has emerged, and it turns out to be nature's own. The interesting feature of a lightning bolt's path, for example, was not the straight line denoting its direction, but rather the distribution of its zigs and zags. A new kind of symmetry has emerged, not the left to right or front to back, but of small scale patterns to patterns on larger and larger scales. The self-similarity of a broccoli floret whose tiny bifurcations echo the branching of the stalk as a whole. Fractals also describe the way things cluster in space and time. Mandelbrot made his most important early leap of imagination when at IBM he was asked to examine the problem of noise, unexplained errors in electronic transmission lines. It was a nasty and expensive problem for the resident experts. The errors were not completely random. They tended to come in bunches, and Mandelbrot realized that the degree of bunching remained constant whether he plotted them by the second or by the hour. Oddly, the patterns that arose and the mathematical description of them seemed to apply just as well to very different problems. From fluctuating cotton prices since the 19th century to the rising and falling of the Nile River through 2 millenniums. Things wear their irregularity in an unexpectedly orderly fashion. They have self-similarity on different scales. When you zoom in, looking closer and closer, the irregularities don't smooth out. Rather, they tend to look exactly as irregular as before. To economists, some of Mandelbrot's fractal patterns looked indistinguishable from records of stock market prices. Economists needed to understand the heretical idea that prices don't change in a smooth, continuous flow. They can change abruptly in instantaneous jumps. And dam builders, reservoir builders, and risk insurers of all kinds needed to understand that traditional notions of probability were leading them to underestimate the likelihood of the rarest, most catastrophic events. In economics, daily fluctuations are treated one way, while the great changes that bring prosperity or depression are thought to belong to a different order of things. In each case, Mandelbrot says, my attitude is, let's see what's different from the point of view of geometry. What comes out all seems to fall on a continuum. The mechanisms don't seem to be different. Now, Mandelbrot's patterns were generally very closely allied with the patterns found in nature. And it's lucky that he started doing his research in the computer age because the computer helped out in such difficult calculations that were required to recreate some of these patterns. I'd like to show you a few of the designs that Mandelbrot took a close look at to suggest the kind of structures that he was finding in nature. Now, I don't think a picture of a snowflake is out of place in a financial conference, particularly this one, since so many people have called Elliott wave practitioners pretty flaky anyway. What Mandelbrot was saying was that the entire picture is made up of elements which themselves take the shape of the entire picture. This snowflake has a particular 6-section design, and if you look very closely at each of the separate sections, they take the exact same shape as the whole. If you look even closer at the makeup of each section, you'll find that it, in turn, is made up of 6 sections, which reproduce the picture that the whole gives us. Let's look at another one of the designs. This is a rough depiction of the broccoli floret referred to in the article. Notice we have the same thing going on here. 2 branches upward into a branching sequence. And at this separation point, 2 branches upward into a further branching sequence. If you take it from this point, 2 branches upward. If you take it from this point, 2 branches upward. From this point, 2, 2 more, and 2 more, right into the end. 8 different degrees of trend, as Eliot might have put it. Again, the whole is a picture which is exactly the same as each of the parts. And those parts add together to create the entire picture. One of the designs in Mandelbrot's book that caught my eye was this one. He was trying to show that what at first glance appears to be kind of an irregular, jagged, random progression of upwards and sideways movements was actually following a model of which the smaller portions were the building blocks. In other words, the smaller portions took exactly the same shape as the larger portions, which took exactly the same shape as the whole, ultimately. Well, had Mandelbrot, instead of using sideways to denote what in the stock market would be corrections, used declines, we would have a picture that is very close to what the average stock market chart looks like. My contention is that R.N. Elliott was saying exactly this same thing 50 years prior. He said if you take a look at the whole and then look at its components, you will find that the component takes the same shape as the whole. This 1 and 2 is the same shape as this 1 and 2 in circles. If you look at the component of this 1 and 2, you'll find the same shape. And if you go down to this degree, you'll find the same shape. So the building blocks take the exact same shape as the larger elements, which take the same shape as the larger elements, and so on, and to the highest observable degree. I had mentioned earlier that a lot of people were taken aback by the concept that the small degrees of trend and the large degrees of trend were created by the same sequence of psychology. Just to show you the real world method for recreating a 5-wave structure, I'd like to ask how many people here have ever observed the trading on the New York Stock Exchange or in the pits in Chicago? Okay, a lot of you have been there. Well, you can see this kind of psychology, the 5-wave psychology, operating at extremely low levels, extremely short time periods, just as you can see it operate on the longer-term trend. The question is, do the individuals involved, those people who are trading the extremely short term, do they really think in crowd psychological terms? These people may be changing their minds quite often. Are they really doing it in concert with some kind of larger trend? Well, I think the answer is yes. I sat in a trading room once, off and on, for about a year. And I was amazed at how many times I saw an individual trader change his opinion in the course of one day. He'd be watching the screen, and he's watching the ticks go to plus 200 and plus 300, and he was bullish as he could be. And a half hour later, they're going plus 100, plus 50, and heading toward the minus zone, and he was turning bearish and selling some stuff. He never made a lot of money. But he did take his cues from the overall market and change his mind very often during the day. Now, I was watching the activity in a pit one day, and I noticed something very interesting. A lot of the times you would see that same kind of activity come in bunches, as if there was an advance and a contraction, almost like volume, expanding and contracting. And I began to realize what was going on. Here's the pit operating, and let's say there's been a bear market going on for a week. Now, to a pit trader, that's a major bear market. It's already worn him out. 5 straight trading days of declining prices with small rallies along the way. And one day they're watching the tape, and it's kind of slow because volume is sort of reseeded during the decline. And all of a sudden the market seems to be stalled out. And a couple of those traders who've been there for the longest period of time, you know, the really grizzled old guys that really know the game, you know, they've been in it for almost 2 whole years. In the back of the room are watching the tape, and they say, buy me 10, buy me 50, buy me 100. And a few heads turn because, you know, these are pretty good sized lots. And the market, sure enough, starts to tick up a little bit, and then it stops again and starts to recede very slowly. And most of the other people taking a glance at the prices are saying, it's the same old stuff. Here's a rally and a decline. We're going to come back to new lows just like we've been doing for a week. Forget it. They take another bite of their sandwich, and they keep half of one eye on the board. And all of a sudden they notice a few minutes later the market isn't making a new low. It's holding at a higher bottom. Well, to a trader, that's a fundamental news event. And he starts watching more closely, and all of a sudden they're getting a little bit excited, and 1 or 2 orders pop out, and the floodgates open. They're screaming and yelling, get me in, I want to buy so-and-so, buy this, buy that. Sure enough, prices are roaring up like this, and it's a typical broad, powerful third wave. It ends abruptly, and another reaction sets in. And the guys who bought a little bit late have had a bit of a disappointment. They're at kind of a loss here, but it's still a 4th wave. Now, behind the scenes, over, you know, in the corner there, are some of the younger traders. They've only been trading for about a week and a half. But they're keeping an eye on this action, and they're saying to themselves, man, look at the money we could have made just then. Look at that wild move. God, if I'd only been long. I tell you what, if this market starts up again one more time, I'm going to buy it. I'm getting ready. He's watching closely. Sure enough, it starts up again. Those young guys are starting to yell their orders, buy me one, buy me one. The orders from Merrill Lynch finally make it down to the floor, and the final flood as the 5th wave goes up, and those wise guys that started it all croak from the back, sell me 10, sell me 50, sell me 100, and the 5-wave move is over. And there you've created the same 5 waves of psychology, and the whole thing took about 35 minutes. Or maybe less. Sometimes it may have taken 4.5. But that step up probably is the start of another larger sequence of 5 waves. That in itself is wave 1. And then wave 2, the pullback develops in the same psychology, but on one larger degree and taking a bit longer, starts to develop. And wave 3, 4, 5, etc. carries on until you've got a full-fledged bull market lasting 2.5 days. Well, Mandelbrot did not describe or list the particular fractal patterns that nature presents. In fact, when it came to prices in markets, the interviewer said that he had no way of describing what the patterns were or predicting what the outcomes would be. In fact, R.N. Elliott did both. He described the real-life patterns that occur in the market, and then he began to develop, through observation, rules and guidelines which would help him predict what the next pattern was going to be and ultimately where it was likely to carry. Now, what's probably most important at this point to keep in mind is that all of Eliot's work was done empirically. He did not come to the market with a preconceived notion about what he was likely to find. He didn't sit up in an ivory tower and say, well, I'm interested in squares. 9 and 16 is the squares of 3 and 4, and I think maybe the market should follow this kind of pattern. Or like someone else might observe the music of the spheres and the movements of the planets and say, well, this is the way we should see things develop in the stock market. He didn't do that. The man was a practical gentleman. His training was in accounting, and the basis of accounting was to look at bits of data and come up with a concept for the whole. And that's what Eliot did in developing the wave principle. He did not come in with a preconceived notion. In fact, he ultimately developed the mathematics of the wave principle, but he actually wasn't the one who discovered the connection. Again, Charles Collins comes into play. He's the man that Eliot first wrote to back in the 1930s and revealed his discoveries to. And one day, several years into their correspondence, Charles Collins wrote Eliot a letter. And he said, by the way, did you happen to notice that the number of waves you claim to identify in market movements recreate the Fibonacci sequence? And Eliot, for all practical purposes, said, what's that? He'd never heard of it. Well, he began to do some reading, and with each passing page, the scales began to drop from his eyes. And ultimately, he decided that the Fibonacci ratio was the essential determinant of the entire development of psychological wave structure in speculative markets. Now, how is the Fibonacci sequence recognizable in the patterns created in markets and identified by R.N. Eliot? If you draw the simplest expression of a bear market, you get a single line from top to bottom. That's a bear market. If you draw the simplest expression of a bull market, you'll get a single line to the upside. If you want to draw an expression of the entire cycle, bull and bear, up, down, a total of 2 lines or 2 waves. Now, if you drop down to the next degree and observe how those waves are constructed on the next degree of trend, you will observe that a bear market subdivides into 3 waves, a bull market into 5, the complete cycle into 8. If you look at the subdivisions of the waves within the 3-step bear market, you'll see 5 down, 3 up, and 5 down for a total of 13, a total of 21 waves upward in a bull market, a total of 34 waves in the complete cycle at that degree. Well, you can continue this through further numbers, and you'll find 55, 89, 144, 233, 377, 610, 987, and on. The further down in degree you go, the more waves you will get, and it will create the Fibonacci sequence of numbers. Well, what is the Fibonacci sequence of numbers? This number sequence has actually been known for thousands of years. It was known by the ancient Egyptians. So it's fascinated human beings for about as far back as history goes. First, we're going to look at some of the mathematical properties and then try to decide why this is of importance to us in the endeavor we have before us, which is to decide what the Eliot wave principle is all about. The way the Fibonacci sequence is created is to take an initial number, starting with the number 1, and add the preceding number to it to get the next number. In this case, starting with the number 1 and adding the preceding number, well, there isn't one, so 1 plus 0 is another 1. If you take this digit and add the preceding number, 1 plus 1 gives you 2. Starting with 2 and adding the preceding number, 2 plus 1 gives you 3. 3 plus 2 is 5. 3 plus 5 is 8. 8 plus 5 is 13, 21, 34, and so on. As the sequence moves outward, the ratio between adjacent numbers approaches an irrational number, a number that cannot be expressed in a finite number of digits after the decimal point, and that number is 0.61809, on and on and on and on. The ratio between the first two numbers, 1 and 1, is 1.00. The ratio between 1 and 2 as a fraction is 0.5. The ratio between 2 and 3 is 0.66666, and so on to infinity. The ratio between 3 and 5 is 0.6. Between 5 and 8 is 0.625, 0.615, 619, 618, and so forth. And within a few terms, you have gotten very close to the three-digit number 0.618. Let's look at the inverse of those ratios. Well, 1 over 1 is still 1, but instead of putting 1 over 2, let's put 2 over 1, so that we've got the inverse. That gives you a ratio of 2. 3 over 2 is 1.5. 5 over 3, 1.666, etc. 1.60, 1.625, 1.615, 1.619, and again, you are approaching 1.618. In other words, as the numbers go out in the continuum, the ratio between adjacent numbers approaches a limit, which can only be defined as the number which is being approached, and that is phi, P-H-I, otherwise termed the Fibonacci ratio or the golden ratio. Now, ratios between adjacent numbers are 0.618 and 1.618. Between alternate numbers, the ratio is 0.382 and 2.618 for its inverse. This number sequence has numerous fascinating properties. Not only is 0.382 the product of 0.618 times 0.618, but it is the net result of subtracting 0.618 from 1. That's just one example. Our book lists many more, and there are other books on the subject that can cover that. That doesn't pertain directly to markets, so we're going to continue along this line and look at another aspect of this particular sequence. One thing that is almost never pointed out, in fact, I've never seen it pointed out with respect to applying it to financial markets, is that the Fibonacci ratio is the governor of additive sequences of this type regardless of what numbers you start with. Now, most errors are made in the market by people who claim to be Fibonacci theorists, you know, and they sell software about how to count 55 points in 34 days and 13 hours and things like that. There's a basic flaw, and that is that the numbers themselves are not critical to determining the fact that the ratio is present between adjacent numbers. To illustrate that, let's pick two numbers out of thin air. I did this up and just pulled the number 17 and 352 out of nowhere and said, let's see what happens along this additive sequence. 17 added to 352 gives you 369. 369 plus 352 gives you 721. 721 added to 369 gives you 1090, 1811, 2901, and so on. You're taking two adjacent numbers to create the third, and that creates your sequence. Let's look at how the ratios behave as you move out toward the end of the sequence. The ratio between 17 and 352 is 0.048, not even close to 0.618. 352 over 369 gives you 0.954. Then the next two numbers, all of a sudden, 0.512, 0.661, 0.602, 624, 616, and within just a few calculations, you are right back to 0.618, which is the governor of these additive sequences. So, don't assume that because Fibonacci ratios are important in this whole picture, that the Fibonacci numbers themselves are always what is most important. In a sense, the numbers 10 and 6 are Fibonacci numbers, at least in their relationship to each other. 6 is about 618 of 10. Well, I'm sure we all remember, getting back to high school here, the number pi, which is 3.1416, et cetera, et cetera, et cetera. That's another one that goes on forever. It is the governor of a geometric pattern called a circle. It's an important number in mathematics, certainly, but what I notice about this particular number is that it is governing a pattern which is static. It doesn't move, it just sits there. A circle merely is. Well, the interesting thing about phi, Phi, the Fibonacci ratio, is that it is found throughout nature, not in static patterns, but in patterns of growth and decay, patterns of expansion and contraction. And that's what sets it apart from most other mathematical relationships found in geometric forms. The most common expression, other than development of Fibonacci numbers in some plants and animals, is the depiction of spiral growth along the Fibonacci or golden spiral. The most commonly referred to animal that follows that growth is the chambered nautilus. This spiral is created by increasingly lengthy radii emanating from the center, and at each 90-degree turn, the radius is 1.618 as long as the preceding one. This continues outward or inward, depending on your perspective, and creates that spiral. These spirals are found, as I said, in the chambered nautilus. They're found in certain types of plants. One that's rather interesting, and as I mentioned, usually it's in a growth pattern, but they're also found in decay patterns. When a poinsettia leaf dies and curls up, it curls up into a Fibonacci spiral. This also occurs in inanimate objects. Galaxies are supposedly expanding and or contracting. They take the shape of several spirals, outward and inward. Ocean waves curl over in the same shape. Hurricane clouds. As I said, many types of plant growth, animal growth, and it's remarkable how long the list is, and it's being expanded every day as people do more work. Besides just the spiral objects, there are others that show the Fibonacci ratio in their dimensions. Chicken eggs, for instance, are approximately 1.618 times as long as they are wide. People, actually, display the 5-3 Elliott idea quite well. You have 5 major appendages. You've got 2 legs, 2 arms, 1 head. Coming out of one of the appendages, your arm, it subdivides into 3 sections. At the end of that section, it subdivides into 5 fingers. Each finger subdivides into 3. So the human body is a 5-3, 5-3. Still trying to figure out where the other 5 is. I've had 2-page letters from dentists who tell me that the teeth are remarkably full of Fibonacci relationships, from single teeth to the front of the mouth to the back of the mouth, and onward and onward and onward. As a matter of fact, some of the most highly paid and successful orthodontic surgeons are those who design the teeth and the resulting look of the mouth in Fibonacci proportion to all kinds of other elements on the face. People continually walk out and say, "I'm thrilled, it looks great." You can have a set of teeth that don't fit the person, and they don't look good, even if the teeth by themselves sitting on the table look pretty good. Well, I think you might well ask at this point, what does this really have to do with the development of the stock market? Well, the best way to display a spiral on a 2-dimensional piece of chart paper is to slide it back just a little bit and let that spiral go around to the area that you don't usually look at. If you draw these spirals emanating from the peak of each first wave of one larger degree, you'll see how it develops. Moves outward from the peak of this very small first wave, touches the top of the first wave of the next size, comes around and touches the first wave of the next size, and so on, thereby reflecting the idea that the stock market is somehow measuring or reflecting a growth pattern. What I think is happening is that the stock market, which is the popular valuation of human productive enterprise, is actually recording the growth of mankind through history. And that growth is not straight line, and it's not random, and it's not even cyclical, where human beings go back to square one every time they make a big mistake. This growth pattern is the type of growth pattern that nature prefers. It is a 3 steps forward, 2 steps back, social and cultural growth through history. And that, I think, is really the essence of why R.N. Elliott's discovery is so important. I think it's a breakthrough in sociology, akin to the breakthroughs in the physical sciences that were occurring 400 years ago. Now, I know what some of you are sitting there thinking. You're saying, all right, Bob, how do I make a buck out of this? So, I guess I'll have to satisfy that instinct too. Well, with the number of waves reflecting so well the Fibonacci sequence, it was not surprising for Elliott to discover that many of the movements in the stock market reflected Fibonacci ratios between their price lengths and occasionally even their time lengths. Now, one thing I'd like to stress, and again, this is an area that has proved to be a pitfall for most people who apply the Fibonacci idea to markets. People usually try to take the simple road out. They either want a black box approach, which this obviously isn't, or even if they take a complicated approach, they want to make it so simple that unfortunately it doesn't work too well either. Usually people refer to Fibonacci in the stock market or any other market as a phenomenon which occurs with regard to retracements. In other words, if there's a big rally, they're going to look for a Fibonacci retracement. If there's a big decline, they're going to look for a Fibonacci retracement on the way back up. They do occur, but I can tell you from experience that Fibonacci retracements are less common and less important overall than Fibonacci relationships between waves moving in the same direction. Let's take a look at this. First, I'm going to cover the most common retracements. And you know what? They're all on this page. This is it. In a 5-wave sequence, a second wave will very often retrace about 61.2% of the first wave. At least as common is a 38.2% retracement of the first wave. Unfortunately, second waves are fairly unruly. Sometimes they don't hit either one of them. They'll stop at a 50% retracement. I've seen second waves retrace 99% of wave 1. There are no hard and fast rules, but I would say that much of the time, 61.8% is close to what most markets show as a limit to wave 2 retracements. That is not particularly reliable in the wave 2 position, but if you count an ABC reaction against the trend and it falls at a typical Fibonacci retracement, it does have added weight for being a turn. Wave 4 is a correction of wave 3. Now, the retracement point for wave 4 is more reliable. It is extremely common for a fourth wave to retrace 38.2% of a third wave. And you will find very often, 4 times out of 5, I would estimate, that this level also happens to mark the low of wave 4 within wave 3. So you will have 2 reasons to estimate before it's bottomed that wave 4 in this drawing is going to bottom at this level marked by the dashes. In extremely powerful situations, you can get a fourth wave that retraces as little as 23.6%, which is the next Fibonacci ratio down the line. It's the ratio between second alternate Fibonacci numbers. It's also the product of 0.382 and the Fibonacci ratio 0.618. However, they're pretty rare, and the most reliable retracement is the 38.2% retracement of a fourth wave. Keep that in mind. It'll help you in many corrections. I want to show you one example of a retracement that helped me in the market. This decline in 1984 occurred following the 1982-83 rise, or 1982-84 rise, excuse me, primary wave 1 of the cycle wave bull market of the 1980s. Now, the previous fourth wave lay very close to the top, and the top was completed with a diagonal triangle in the fifth wave position. We already know from Dave's talk that diagonal triangles are indications of upcoming weakness. I was not ready to believe that we would see only a 23.6% retracement, although we did monitor that number and the previous fourth wave as well, which was at 1158 on the Dow. But much more likely was a full 38.2% retracement, at least, of the preceding five-wave structure. Now, the fascinating thing about applying Fibonacci ratios is they are applicable at all degrees of trend all the time. As this correction began to develop, and we were waiting for the 1090 level to be hit, which was the approximate 38.2% retracement level, it unfolded in three stages. It was actually a triple zigzag formation. Well, it turns out that each one of these zigzags was 0.618 times as long as the preceding one. As we got just a few days from the new low, which occurred in July, you can see what the Elliott wave theorist had to say. If the last zigzag is 61.8% as long as the preceding one, the market should bottom at about Dow 1083, which was only 7 points from the original estimate. And the actual hourly low was 1083.59. You can use these Fibonacci ratios to your advantage, particularly if you look at all the degrees of trend, or as many as you can, throughout your analysis. Of course, the rest, the history you know, we had a turn there, the market took off and went to a new all-time high. Well, that's about all I have to say about retracement in terms of Fibonacci relationships. Much more common are Fibonacci relationships between waves which do not touch each other. That is, they are not adjacent. They are not retracements of the preceding move, but they are within the same pattern. Let's look at the two most common. The first one you already know about. It's the guideline of equality. When you have a five-wave structure to the upside and wave 3 is the longest, waves 1 and 5 tend to be about equal in time and price. Let's look at this situation. R.N. Elliott noted several extended fifth waves during the time he was doing his initial pioneering work. And his observation that has been so useful over time is that the fifth wave, when it is the longest, tends to travel 1.618 times as far as the net travel from the beginning of the movement to the top of wave 3. Notice that this is a relationship between two advancing segments. They are separated by wave 4 here, which is not part of the relationship. It does give you the beginning of the calculation of how long wave 5 is, but the relationship there is between two impulse sectors of the entire movement. Here's one example from Elliott himself. This occurred in the 1932-1937 bull market. The net travel between the bottom, the bear market bottom, and the peak of wave 3, when multiplied by 1.618, gave you the length of wave 5 right to its peak in March of 1937. We've got another example that's a bit more recent. This is not quite the same relationship of waves 1, 2, and 3 having a net travel equal to 0.618 of wave 5. But we did recognize this relationship as it occurred here in the 1980s. The first wave up, the first primary wave in 1982 and 3 ending in January 1984, when multiplied by 1.618, gave you the length of the next rise from the bottom in July 1984 that we just examined a bit earlier, right to the peak, or the twin peaks really, in July and September of 1986. And as you might not remember, given the action of October 1987, this was the largest down day in stock market history at the time. I believe it was 86 points down in one day. And that gave us the Fibonacci relationship between primary 1 and primary 3 before primary 4 got underway. Here is another fascinating Fibonacci relationship among impulse waves. Now take a good look at this chart. I think this is a fascinating series of relationships. The 1932 to 37 bull market, cycle wave 1, had a rise of approximately 377% in terms of the gain. Wave 3, from 1942 to 1966, went up approximately 987%. And the rise from the 1974 low to the 1987 high, again, was just off 377%. You notice anything about those numbers? They're all Fibonacci numbers. I don't know whether that's coincidence or not, but one thing I'm convinced is not coincidence, and that is that the net travel in percentage terms of cycle wave 3 is 2.618 times the percentage gain of wave 1 and of the 1974 to 1987 rise. 987, in other words, is 2.618 times 377. All right, let's look at a couple of other Fibonacci relationships. We've done impulse waves. Now let's look at corrections. In the so-called flat correction, it's pretty self-evident that all of the waves are approximately equal, so C, B, and A are about the same length. Zigzags are quite interesting and quite reliable in terms of their Fibonacci relationships. But again, we're not going to talk about a retracement here. We're going to talk about the relationship between the two downward movements, of course downward in a bull market correction. In this case, waves A and C. Waves A and C very often are equal in length. And when that calculation is coupled with one of the others, say like the previous fourth wave coming into view, it can be a very powerful indication that a turn is upcoming. If wave C is not equal to wave A, it's very common that it will be a Fibonacci multiple of wave A. In other words, 1.618 times the length of wave A, or 0.618 times the length of wave A. Extremely reliable relationships. Now, the irregular pattern on the bottom is my favorite one. And the reason is everybody else on Wall Street is faked right out of their socks. When wave A comes down, people get a little bit worried, but when wave B makes a new high in an irregular flat pattern, caution is thrown to the wind. Remember the kind of psychology that attends a B wave in the first place. It's ebullient, it's hopeful, looking for any reason to be bullish, a lot of speculation going on. When that market hits a new high, that is really cemented as powerfully as it can possibly be. Well, then wave C gets underway. Of course, if you're an Elliott analyst, you're noticing that this is a 3-wave advance, not a 5. Wave C gets underway, and people don't believe there's a problem until it breaks the low of wave A. You can't imagine how many times you see, well, if we get to a new high, I'm turning bullish, and of course it does right here. And, well, if we break the old low here, I'm going to have to turn bearish, and it does. And people get caught right at the bottom going short, and wham, the market takes off again. Another reason I like irregular corrections is that the relationship between waves C and A is so reliable. And that is that C is very often very close to 1.618 times as long as wave A. Here's one example from 1974 through 76 in the gold market. This one doesn't happen to be precise, but it's quite close. Remember, I discussed what goes on psychologically here. We completed 5 waves up in March of 1974, had our A wave down, and when gold hit a new all-time high and broke out in late 1974, particularly with gold legalization right around the corner, it trapped every bull in the book. There was one subtle problem with that wave which said loud and clear, this is a B wave, this is not the start of a new impulse movement to the upside. Gold stocks were refusing to rally to a new high. In fact, they had gotten hurt very badly in wave A and were just struggling to a partial retracement while gold was making new highs as if nothing else was wrong. Technical weakness is very clear in a B wave. Of course, the very last day of 1974 was the peak, and then we had a 5-wave decline for wave C, which bottomed at $103.50 an ounce, approximately equal to 1.618 times the length of wave A. And that completed the correction. Now, sometimes, as I mentioned before, the relationships between, say, a C wave and an A wave can be doubly useful if they confirm a Fibonacci relationship that has already become evident from the larger picture. I want to give one example from real-time analysis from the Elliott wave theorist. In February of 1983, I was looking for a top in the gold market. Now, I want to show you some of the reasons. The wave structure was very important. The rally that had occurred from the 1982 low was taking an A, B, C shape, not the typical 5-wave structure you would have expected if gold were about to blast off to a new all-time high. Another thing became clear as we crossed $500 an ounce. At just above that level, we would hit a point at which 2 Fibonacci relationships would be in place. First, at just above $500 an ounce, we would have retraced 50% of the decline from 720 down to that 1982 low. At the very same level, we would have retraced 38.2% of the entire drop from $850 an ounce. I thought that was a pretty interesting point to watch. As we got closer, what was going on in the internal wave development? This is a picture of daily gold during that period, 1982 and 83. This was the low in 1982, and as you can see, it was developing into an A wave, a B wave triangle, and it was developing into a 5-wave C. But the thing that supported the case for a top here, forgetting the technical indicators and other things like that, was that wave C from the end of the triangle would be 0.618 times the length of wave A at just over $500 an ounce, somewhere in the 510 to 520 area. It peaked at $511.50 an ounce in February and crashed. So, these Fibonacci calculations are very useful if you'll do 2 things. Number 1, always make sure that you are applying the Fibonacci ratios with regard to the Elliott wave patterns. Don't do them willy-nilly just because there's a low and a high. If you don't know if it's a 5 or a 3 or an A or a B, your relationships will not bear keeping because they are probably not related to what's really going on. This actually contains an example. In this corrective B wave triangle, the price low is actually down here at wave A. At wave E, prices are higher, but that was the point to measure from, because the relationship you are trying to discover is that between wave C and A. So you don't measure from this price low. People who don't know their Elliott aren't going to measure from the right point. The second thing to keep an eye on is calculate all the Fibonacci ratios you can and see if they give you a cluster at a good point. We just had an example where 3 different calculations told you that in the low 500s there was a good chance of big resistance, and it turned out to be the top. The last section to explore is triangles. And this is quite simple, really. Again, retracements come in many different types in terms of the percentage of the previous decline or rally. However, it does appear to be the case very often that at least 2 of the waves will be related by Fibonacci, and they are 2 waves which move in the same direction. In other words, wave C in a contracting triangle will be 0.618 times the length of the wave A decline. Not the wave B rally, but the preceding decline. And or wave E will be 0.618 of the wave C decline. In an expanding triangle, of course, the inverse is true because those waves are longer, but those Fibonacci relationships are very reliable. At least one tends to occur in the middle of a triangle. Here's one example from real time, again from the Elliott wave theorist. I mention it because it occurred on such a long-term trend, people could hardly imagine that this kind of relationship would hold over a period of years, but it does. In this bond market decline, from very shortly after it started, the analysis strongly suggested that a triangle was in force, one way or another. And this decline, therefore, was likely to be related by the Fibonacci ratio to this decline. In other words, in this case, intermediate wave C of the triangle should be 61.8% of wave A. And all during these months, that forecast kept being repeated, and it got support. You see this little subdivision here? It took the shape of a triangle again. And when you plotted A, triangle B, and started down in wave C, remember the most common relationship between wave C and A in a zigzag? C tends to be the same length as A. It turned out to forecast the exact same level. The 60 level on the bond market, plus or minus a half, the exact closing low was 59 and 31/32 before bonds turned around and went straight up. By the way, just to give you another inkling of the kind of psychology that occurs at these major lows, the Wall Street Journal ran a special section on opinions from every economist on the globe, it appeared, as far as interest rates were concerned, and the vast majority gave very erudite discussions and proposals of why interest rates had nowhere to go but up. Of course, the bond market made its low then. But this is just another real-time application of the Fibonacci relationship, this time in terms of the waves inside of a triangle. I'd like to bring one other thing to your attention. This is not in any of the textbooks, but it's worth knowing. Sometimes triangles do something that is best described as extend. They create extensions. Look at this triangle in silver. You had A down, a B up, C, D. By all rights, that should have been the end of it, with the E down. But E itself took 5-wave triangular shape, going 1, 2, 3, 4, 5 into the final low. I've seen several of these developments. What's most interesting about it is the number of times that the 618 relationship repeated throughout that form. One declining wave after another was 0.618 of the previous one, spiraling down to the center and getting ready for another impulse wave. Now, I haven't spent much time or effort in assessing time relationships under the wave principle. I would like to invite any of you to do it. Ham-Bolton said, even though he wasn't convinced that Fibonacci time sequences in the stock market were the determinants of the turning points, they certainly seem to happen a lot more than chance would indicate. And my sentiments are those exactly. I don't feel that very often I can rely on a time length in the market being 13 days or 21 weeks or 5 months or whatever. But it is remarkable how many times the Fibonacci numbers crop up in terms of time. Those of you who've read Elliott Wave Principle, it's published 10 years ago, will remember that in one point in the book we suggested that 1987 had a high probability of at least being some kind of turning point, because that was the year that marked a cluster of ends of Fibonacci time sequences. Even then, we didn't know about the 1982 low, which added yet another one. From the 1982 low, it was 5 years until 1987. From the 1974 low, it was 13 years to 1987. From the all-time high in constant dollar stock prices for the Dow Industrial Average in 1966, the top of cycle wave 3, it was 21 years to 1987. And from 1932, when this entire supercycle advance began, it was 55 years to 1987. We said, hey, this looks like more than a coincidence. Let's keep an eye on 1987. I assumed when I started doing Fibonacci analysis that the time element would tend to subdivide the same way the price element did. In other words, along Fibonacci lines. If an advance lasted, to pick a number, 260 days, then perhaps the decline would last 160, being in Fibonacci relationship. I'm sad to say that the results of that were not rewarding. If there is a Fibonacci determinant of the time element, it is more complex than I've been able to determine. So again, I invite you to take a look at it. It's going to take somebody a lot of work, but he should make a name for himself if he can crack that code. One last example, and this is in the category of oddball Fibonacci relationships. I include it only because I was either foolish or daring enough to go ahead and recognize these things in print several years ago. This was back in June of 1980. We have a chart here of interest rates on 90-day Treasury bills. Of course, they'd come from a low in 1976 to an incredible all-time high right here in early 1980. We had then experienced a collapse in interest rates. I believe that was March of 1980. And as it was developing, I was counting waves, and it went 1, 2, 3, 4, and then it was subdividing 1, 2, 3. And I noticed that if I took the peak value of interest rates here and multiplied it by 0.618 and subtracted that length from the high, it came out just a bit lower than rates were at the time. And I said, well, if we need to complete 5 waves, we do need to have one slightly lower low. The Fibonacci relationship would give us 6.38% on the 90-day Treasury bill, and that turned out to be the exact low to the 100th. And rates bottomed and turned around. Now, I don't know if I can form a guideline out of that one, but it does tell me one thing: keep your eyes open. These things happen more often than not. Well, I have to tell you that these types of concerns, this type of information, this type of stimulation to thinking about all different kinds of subjects is what keeps me interested in markets. If I were a fundamentalist and I were trying to guess what the next day, week, or month's news events were, if I were an economist and developed a black box model and just waited for the computer to spit out the answers, which usually don't work, if I were a technician who were only watching the 10-day oscillator on the advances and declines, I would have been bored to tears and quit this long ago. But the fact that the wave principle is on the frontier of what is happening in the science of sociology, and that new discoveries can be made every day in this endeavor, keeps me stimulated and interested. And I hope it will do the same for you. Thank you very much.